Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Okay, everyone. Welcome to the show. Thanks for joining us. We count down 2018, literally just a matter of days away before the clock strikes 12 and we head into 2019. And if you've been tuning in to the Smart Property Investment Show over the last couple of months, it's been a bit of a theme. It's about what 2019 is going to look like. And I think this year, more than years past, with a fair amount of uncertainty in the market, and by the market, I'm talking mainly around Sydney and Melbourne, which has captured all the attention for the last sort of 9 months of this year. People are wondering what's going to happen. So we've been covering this off, and I've had a range of people come through the studio over the last couple of months, mainly property demographers and economists and sort of a cadre of those type of people that like looking at numbers and set their projections out for the year moving forward. And I've had some good discussions. I've enjoyed the conversations with them. One thing I would take from pretty much anyone I've spoken to around this is that don't get swept up in a lot of, we'll call it panic in the market around sort of spiraling prices in Sydney and Melbourne. The sky's falling in. Everyone's going to blow their dough. We're all going to end up poor. You know, everyone seems to have a level of confidence, sensibility, yes, but confidence around the stability of our property markets, albeit a softening property market. But you need to remember that all property markets go through cycles, and cycles means they don't always go up. A lot of investors, if they enter the Sydney market back in 2012, they probably think they're the king of the crown because they have only seen increases in prices. If you've purchased property in the last sort of 2017 in Sydney and also Melbourne, you've probably seen property come down. So property does move up and down. We've covered it, I think, nearly to death. There's not much more we can say about that. But what I want to do today is have a look out into 2019 rather than looking backwards to 2018. Obviously, history dictates the future, but things in property move pretty quickly. So the next couple of podcasts we're going to be doing is thinking about 2019, how you should be framing your property investment decisions and how you approach property into the new year. If you're geared, you're ready, you're poised, you've got all your ducks in a line, I think 2019 might be a good market for you, but you need to have the confidence to capitalize on those markets. To help me out today to have a chat around this, Anna Porter. She's a director at a company called Suburbanite. You've probably seen on the TV before. Anna, how you going? Thanks for joining us.
Very well, thanks. Great to be here.
How's 2018 for you?
So 2018 was an interesting year in the property market. We still had a lot of strength sitting through Sydney and Melbourne, and our clients really prospered off the back of that. We started to hear the whispers that Sydney was going to come off and Melbourne, but, we certainly didn't see that till the latter half of the year. So it was still a really great year for us. And, the Royal Commission didn't hit us too hard, to be honest. We've been pretty fortunate through that.
So Royal Commission are looking to hand down its findings in February, so a couple of months away. I saw only today, actually, we're recording this, that APRA, and you've probably got some views on this, has removed its limits on its cap on in interest-only lending. I think I've got that right. So things are starting to change in the lending market right now, and obviously 2018, a big theme of that, and you've probably seen it in the clients you've worked with, is your ability to get finance. So do you think it's going to get a bit easier into 2019?
Yeah, so we have to remember the banks are in the business of lending money. They want to lend money. It's how they make money. And let's be honest, the banks aren't exactly short a buck or two. So it's really for them just understanding the new environment they're playing in and how they can, for lack of a better word, work around it or work within it to make sure they're doing the right thing, but still getting money out into the marketplace. So it was only a matter of time before the banks really worked hard to keep APRA happy, and adopting to the new changes that have come through from the Royal Commission. They will get there. It's just they have to play by the new rules.
You think finance is going to be easier in 2019 than 2018 to secure as a borrower?
Look, I'd like to think so. There are some real changes around serviceability, and I don't think that's going away. So there's still going to be certain lenders that might have some struggles there. And, to preface this, I'm not a mortgage broker. We don't do the finance side of the piece, but we get a lot of exposure to it. So, there are still going to be some clients out there that will have a bit of a tough time. There's probably some out there that have gotten money in years gone by that shouldn't have, really. Let's be honest. I think it's what they're trying to take out of the marketplace is some of the dodgier deals, some of the things where people are positioning loans incorrectly. Brokers might be putting down information that's not as correct as it should be, or exaggerating or using a little bit too much liberty. That sort of stuff will stop. But that shouldn't have been around anyway, so that's a good thing for that marketplace. Going into the next year, if you've got some serviceability, you've got a bit of capacity, you still shouldn't have trouble getting a loan.
I completely agree with that. And there's a lot of people who are looking to capitalise on this market right now, and we'll get into it around what 2019 is going to look like and potential opportunities for investors who haven't been able to get finance. Now, if you get rejected for finance, there's probably a good reason why.
Very likely.
So don't feel too disheartened about it. Just potentially maybe you need to shape the way in which you approach property investment, your strategy towards it. Maybe you should be looking at different types of properties in different locations with different fundamentals to them. Are people that sort of who are in that situation who may have been able to borrow 500 grand beforehand who can now only borrow $300,000? Are you seeing that in your client base at all? Are they shifting?
Yeah, we're seeing the numbers come back a little bit. So, in the days gone by, they would have had the extra 100 or 200,000, and that's often what the case is. It's not that they can't borrow the money. It might be that they can't borrow as much, or they can't borrow it today. They might need to reshape their finances and get them a little bit more in order, cut out that extra ski trip each year, cut out the extra date night, things like that, to show the banks that they have the affordability. So it's a little bit more of a preparation time. I suppose gone are the days where you go to the lender or the broker, you have a pre-approval in 2 days. It's a little bit longer now. And if they're borrowing less, there's certainly opportunity for investors with lower budgets. It just might not be the suburb next door to where you live, which really, if you're investing well, you should be diversifying anyway.
So we haven't met before, but I'm familiar with your business. And for our listeners who aren't, what do you guys do?
Yeah, so we are a property investment and advisory business. So we work with individuals, so time poor professionals, mums and dads that want to invest well strategically. So we don't do the off-the-plan stuff like a lot of other investment firms in the marketplace. We offer an end-to-end buying service for properties throughout the country that are established properties, and it's about strategy and how to get that right and how to avoid the costly mistakes. We go all the way through to working with big corporates and commercial style investors. So we work with a lot of clubs, not-for-profits, just organisations that might have a trail of dead assets that they've acquired over the years without strategy. And our whole team come from a background where we're all property valuers. So we've got degrees in land economics and things like that. We've worked as valuers for a long time and seen what makes some markets perform and what makes other markets not perform. And we now bring those expertise to our clients.
So do you focus on investors or owner-occupiers or both?
We do a bit of both. So my team at head office, our acquisition team, focus on investors only. We've got sort of teams split up. And then we've got our partners that do the home buying that sit inside our business as well. So I don't do a lot over the home buying side of it. I've got some great people that look after that because it's a very different approach. There's only so many times you can walk someone through a home and see if they like the shape of the window or the aspect, but investing's a little bit different. It's about the numbers, the analytics, the fundamentals, whereas people will buy, I did it myself. So I bought a beautiful home in Yowie Bay, which is in Sutherland Shire of Sydney, about a year ago, something like that. And a few people came up to me and said, but you're telling everyone not to invest in Sydney now because it's about to hit the peak and you just did it yourself. I said, hold on a second. I bought a home to live in and, probably paid too much in a market that's overpriced at the wrong time. But I've invested really well over the years that I now have the luxury to make stupid decisions with my own home. What is the view worth where I like to sit and have my coffee in the morning? What's it worth to have the kids go to the school 2 streets from where we live, or the boat ramp my husband loves down the road? All those things to us are worth money. And if we hadn't invested well, we wouldn't have the luxury of making those sort of more emotional decisions. And that's what home buying is compared to investing.
So 2 very different things. If you are looking for a home to live in, you're going to have a very different way you shape your decisions compared to if you're investing to invest for wealth creation purposes. Exactly. Do you think most people get that disconnect wrong? I've seen a lot of investors personally go through looking at properties thinking I'm going to live at it rather than do the numbers stack up.
We get that all the time. So part of our job and what I often say to our clients is if I let you make an emotional decision around your investment, would I live there? Do I like the facade? Is the colour of the paint the right colour? I'd be doing you a disservice because you would buy the wrong property for the wrong reasons. And if I talk you out of a great home that suits all your needs because it's not a great investment that year in that market, well, I'd also be doing you a disservice. So they're very different drivers. Homeowners and investors often don't get that right. But there is some things that you can actually quantify through that. So when people say, I really like the feel of this house, I really like the location, all of those things are actually quantifiable. That is some of those fundamentals, those measures that say, well, people want to live here because it's in a good school catchment. That has a value attached to it. Yeah. You can actually quantify that. The good feel of a home, even though it's a very general term, can often be that it's nicely finished, good floor plan, good natural light. And those things, again, are quantifiable. It's our job to take that to a level where it's quantifiable. And that might be the difference between you go to a home, it's lacking privacy, has poor natural light and isn't in a good street. Well, that property won't perform as well as the one that does tick all the boxes. It won't rent as well as the one that does tick all the boxes. So it's not about making emotional decisions, but it's making the right decisions with the things that should be quantified because those things will still often sit as fundamentals behind good investment decisions.
It's very good. So I'm conscious that a little bit of criticism I get on this show is that I'm a bit too East Coast centric. I probably don't cover Perth as much as we should do, or Darwin, or even the sort of South Australian Adelaide markets. And the reason for that is that most of the investing activity happens in the locations along the east coast of Sydney, there is some very good buying opportunities in other parts of Australia as well.
Certainly are.
There is. Even Hobart, it's east coast.
I debate you on that one.
How have you seen 2018 for property investors? Has it been a difficult environment to invest within, or are people absolutely killing it right now if they're doing it well?
A lot of our clients are making really good amounts of money off their investments. For example, we've been buying a lot through Melbourne and Geelong, and clients have been making the likes of $50,000, $60,000, even $100,000 in 12 months to 24 months of purchasing the property. Now, that's a really good outcome by anyone's measure. I myself bought a property in Geelong. I only held it for about 14 months actually, so it was a very short time, might have been 15 months. In this last 12-month period, we bought it for $426,000, and we're looking at putting it on the market at offers over $550,000. So that's a pretty good outcome when everyone's talking about doom and gloom. That's a spare $100,000 in my bank account. Yeah. That's not very doom and gloom to me. And our clients have had the same sort of outcomes. And it's been mostly through Melbourne, through Geelong, through, still parts of Sydney was still growing up until recently. Definitely down around Adelaide. We've seen some great results out of there. Canberra's been going incredibly well. You talk about, I do, a few TV shows, and again, they're national platforms get the same criticism as you, The hosts are from Sydney and they say, the market's crashing. I said, you go spend 5 minutes in Canberra, you've got 35 people at an open home all bidding on top of each other. So the people in Canberra are watching this show saying, what doom and gloom? It like you say, it's cyclical. Every market moves at different times.
So it's not doom and gloom?
It is not doom and gloom if you step outside of Sydney and Melbourne.
Okay, that's a good point. So for investors who are thinking it's doom and gloom and they listen to this podcast, and there's lots of them that do, and they go, hang on a second, maybe I need to realign or readjust my thinking. How do you as an investor, if you're Sydney-based or Melbourne-based, get outside of your own comfort zone, your maybe some misaligned perceptions about investing outside of where you live, into these markets? How do you go about doing that? Because I use a buyer's agent for everything that I do, so I get access to that. I'm not jumping on planes looking at places. I've got properties up in Brisbane I've never even seen, right? But I know someone has seen them and done all the due diligence. So how do you as an investor get out there and look at new opportunities?
Yeah, so start with the first things not to do. Do not buy a property off the internet without looking at it, because that can be fraught with danger. Do not get your father-in-law, brother, mate, ex-work colleague to be the person on the ground to look at properties and make decisions for you interstate. They're not trained, they're not skilled, and if it goes wrong, you've also lost a friendship there. So there's a couple of things there to be really careful of not doing. Do not either go interstate and buy a property or 3 or 4 properties in the one weekend, because you won't know that market. You cannot get savvy on the ground in one weekend. You have to spend the time doing the research. And if that means you want to do it yourself, you're going to spend we spend 6 months in a market before we even buy a single property there. You're going to spend a significant amount of time educating yourself. Call some of the local valuers on the ground in those areas. They're not real estate agents. They're not biased. They're not going to give you an agenda with their opinion. They're going to tell you what's happening in the market, where to buy and what to avoid. So, lean on those resources. Pay them a bit of money if you have to. If you don't want to go down that path of spending every weekend house hunting, because I promise you it's only fun for the first 2 weeks, then you need to lean on some experts. And those experts are buyer's agents that know those markets. Now, you shouldn't be using the selling agent to give you your advice. Their job is to get the highest price for their vendor, and they do a great job at it, in their space, but they're not there for the buyer. And if they tell you they are, well, that's a bit of a misconception. Buyer's agents work exclusively for the buyer. So I always suggest there's a couple of things you want to check. What are their licenses and qualifications? If they've woken up, 12 months ago and they used to sell printers for a living, and they saw the block and stamped expert on their business card, and off they go after doing a 3-day online course, they may not be the right fit. You want someone who's got some real experience in the industry for a long time. So you want to make sure they've got the experience behind them. You also want to make sure that they're fee for service is my belief. I know some people have a different philosophy, but I believe if they're working for you, you should be paying them. If they're getting paid by a developer or a selling agent or someone else in that relationship, they're probably not doing the best job by you, because they can't. Legally, they have to work for who they're paid for. So a couple of things to definitely check. And if you're not sure where to find the right buyer's agents, have a chat to some of the local selling agents, have a chat to some of the solicitors, accountants, financial planners. Those people will interact with them regularly.
And you've echoed a lot of sentiments that I've expressed for this show for quite some time. To your point around how do you find a good buyer's agent, asking some of the selling agents is a good point. And my view of this, and having spoken with many, many buyer's agents and sales agents have a bit of a love-hate relationship.
Sure
often
do.
Buyer's agents are a critical part to selling agents, depending on market fluctuations and timing. Sometimes selling agents absolutely despise buyers agents, right? And you typically know when a market is changing from what I've seen when buyers agents start getting more phone calls than they're making phone calls, right?
My phone has been sitting here buzzing, and I reckon 3 of those text messages will be agents in markets that are calling saying, do you want to buy this? And when the market's calling, my answer is no, thank you very much.
Which markets are they? Do you think they're calling in from right now?
Yeah, so we're definitely seeing a lot of people coming through, a lot of agents coming through from areas around Wollongong, Newcastle, because those markets are taking longer to sell. Same with Sydney, there's a lag in the sales. Definitely in Darwin, not that we've been buying in Darwin, but we're definitely seeing that as a market that's still retracting and still struggling. They're probably the ones we want to avoid the most. But there's still opportunity out there in the right markets. WA is on our, to talk about the other side of the country, you mentioned that's probably something that gets missed a little bit.
Oh, it doesn't get missed, but we could probably do it a little bit better.
Look, WA is on our watch list. So we've seen the retraction in values has stabilised now. We're not seeing much negative growth coming out of the inner suburban metro areas. Obviously, regional WA is a little bit different. But the metro areas, that's stabilised, which is a great sign. It's stabilised for a little while now. We've seen that coming through for about 6 to 12 months. There's certainly a little bit more positivity around that job sector and, more diversity in that too, which is fantastic. The population migration is starting to increase, which is also good. The only thing we're waiting for that we haven't jumped into WA just yet is we want the vacancy rates to come down, because there is a direct correlation between what happens in the growth of properties and how the vacancy rates perform as well. So if you've got a high vacancy rate, that can often signal an issue with supply and demand. So we're just waiting for them to come down a little bit more. But I would say back end of 2019, that's where we're looking at that market as being a good opportunity. It's certainly starting to show all the right signs.
So you mentioned beforehand that your team are primarily valuers.
Mm-hmm.
What does a valuer do? Because I think there's some misconceptions from property investors around their job and how they go about doing it and what they see that other people don't see.
Yep. So the general consensus is that valuers cause headaches for mortgage brokers, and I'm sure there are some out there that do that, don't get me wrong. The role of the valuer is to look at the marketplace and provide evidence-based information on what a property could be worth based on market sales and transactions. So they're not there to dictate the market, they're there to interpret the market.
At a point in time. So they're not valuing for the future, they're valuing for that moment.
This is true. And it's usually under the bank's parameters when it's for a lender. So often valuers get told about, or criticised, for being conservative. That is because they have to follow the bank's rules. And the bank's rules are that you have to use sales that have settled, not ones that are exchanged and unsettled. You have to use them that are within 6 months old, ideally 3 months if you can. And there's a huge amount of parameters they have to hit. So by the time a property transacts and then it settles, then it hits the databases that they gather that information from, it could be 3, 4, 5 months old. So they're actually working a little bit in retrospect, and unfortunately that is out of their control. It is the policies the bank impose upon them. So in a rising market, they can fall slightly behind that, and they're not there to project future growth, future movement. That's just not the role they play. So a good valuer should follow, those parameters, but also take consideration to what's happening in a moving market and adjust accordingly without projecting to the future. Sometimes that's hard when valuers are getting slammed with 10 or 12 jobs a day from banks. It's a tricky environment to work in for them at the moment. So I stepped out of valuation probably about 7 or 8 years ago for that reason, because, the job started to, became very challenging when the banks wanted volume work. I don't feel we had the opportunity to do our job properly, and that frustrated me to no end. Great skill set, but it frustrated me that we weren't able to do our job properly.
And you use that skill set today, no doubt.
We do. So it's looking at, what should things be worth? How do we understand not only value-wise, like the dollars and cents of it, it's also understanding what fundamentals make properties perform. So some of the things people miss in a marketplace is when the market's strong and everyone's buying up every property for probably a little bit over what they might be worth, and there's a strength in the market, properties with problems get forgiven, right? So the property that might be the basement unit that has no natural light, the property in the flood zone, the property that's just the rubbish old house with no natural light and the neighbours over the fence can see everything you do. Those property, there's a lot of forgiveness in the marketplace and they still go up in value and people still pay high prices. As soon as the market turns, those properties cannot be shifted. They cannot be rented. They cannot be sold for a reasonable price, and the discounting settles in. So part of our role as a valuer is to help protect our clients from the problem properties, not today, but in the future when the forgiveness is not in the marketplace. And even just the fundamentals of the market where the forgiveness is not there. So the volatility. So right now, for example, underlying the market, there's a lot of investment firms out there that are saying buy in Southeast Queensland and buy in Tasmania, and it's all going to go well, and everything looks great. You know, especially in Tasmania, you can buy for $250,000, $300,000 to get you $350 odd a week rent. You know, on paper, it looks too good to be true. Now, being a valuer and having worked in big, broad portfolio work for huge investors that have portfolios across the country was some of the roles I've done, and also doing distressed assets for a lot of years. What I saw was when a market is driven by investors, it's incredibly volatile. So think Gold Coast in years gone by. It has this boom and bust effect. So right now, Tasmania's had a good year. It's had, Hobart's had about 8%, 9%, depending which, data you look at, growth in the last year. So every, I would say, maybe newer sort of guru to the marketplace or property investment expert that hasn't been around as long is thinking that is a really good opportunity. But there's been investors that have driven into the market. It's not being supported by job growth. So for every 5 people that move to Tasmania in the next 3 years, there'll be 1 job created. That's not enough. It's not underpinned by population growth. It's not underpinned by employment drivers. It's not underpinned by the locals paying higher prices because they're earning more money. None of that is there. The fundamentals are wrong. So when investors push the prices up and the locals can't sustain that, and then we get an interest rate rise, and it might not be in line with the RBA, it might just be the banks whacking interest rate up in the back end on everyone. When we get a couple of, a bit of vacancy kicks in because obviously there's not a big enough population there, so you get properties that are sitting vacant for a long time, rents get discounted, interest rates go up, the economy tightens, you start getting distressed asset sales. Get a few of those, you start to have this flow-on effect where that whole market collapses. So that's probably where we differentiate a bit as valuers, is we've seen those fundamental issues, those volatilities that sit not only in properties but in markets, and that's what we're really careful with our clients steering them away from. And that's where probably our opinion will differ quite a bit to a lot of other investment sort of advisors or gurus or economists out there. There's a lot of them spruiking and, Hobart and putting all their eggs in the Hobart basket, and we're saying stay well away from it because of that volatility. We're saying that next year, 2019, will be the year of reckoning for Tasmania. It's had a good year. That'll be wiped out towards the back end of 2019 into 2020 with that boom and bust effect. Very similar issue down around Southeast Queensland. A lot of investment firms have jumped on that bandwagon. There's a massive supply issue. Oversupply is going to be your biggest risk factor. So again, we look at that volatility of too much investor activity, creates vacancy issues, then creates this flow-on effect. And I've managed portfolios for lenders that, for about 2 years where we were doing distressed assets and mortgagee in possession. I've gone in with the sheriff right behind him, scariest thing you can do, heartbreaking, and watch families torn apart. And I've learnt what has created that. And a lot of the time it's been those markets with those volatilities. So we don't look at just what's happening today. We can't predict the value for the future, but we can predict market volatility for the future. And that's a big part of what we bring to the table.
So you just heard a different opinion, and
not a very popular one either sometimes.
I'm not going to disagree with your opinion. It's that's the way you see the world, and I think the message here is that there's many different ways to look at different marketplaces and the dynamics of markets and how it will influence the investability of those markets over time. So you just dealt with quite a lot of, I counted about 4 or 5 pretty significant, what do you want to call them, factors which are going to shape property markets. So I think we've got to get you back on the show at some point in time to actually dig down a little bit more into them, because they warrant more explanation. But I think that's, go back and listen to that last 5 minutes, and I think you should take quite a lot out of it. Just all those different factors which can change the way in which you might want to invest in particular locations. And it's irrelevant to Tasmania. It's relevant to all markets.
It is. And when you look at, say, Adelaide as a contrast to that, it has the exact opposite of long-term sustainable projects into the billions in terms of spend, which creates jobs. There's thousands of jobs coming to Adelaide, and put those things together on the opposite side of the fence where people will move to an area and it's supported by both home buyers, local buyers and investors. And you've got yourself a really good sustainable market and a really good growth story for the next 3 to 5 years.
Yeah.
So you can pick both sides of that fence and look at what is the right decision. But I think as well, when you get different opinions from property people, it also comes back to the investor's strategy. Some people are investing just for yield and they don't care about growth. Well, that's a totally different strategy
very
again.
different. Yeah.
So,
and Tasmania can be great for that.
It has a great yield, and I'm not going to deny that. It has a very good yield. Yeah. So if you're chasing growth, my advice in that respect might be quite irrelevant to you.
And for a lot of people, if you look at sort of portfolio mix-up, they might want a yielding property to help offset some capital growth properties as well, to give them the cash flow so
balance
they can hold.
Is very important. I completely agree. It's got to be a balanced portfolio. So, that's certainly something where, whilst I might sort of have a different opinion to some advisors out there, it's not necessarily tailored to every investor's strategy either. That's just a general opinion. Everyone has a different approach and why they're selecting certain properties in their portfolio.
Absolutely. Isha Ronan, and going on the, I guess, the topic of advice, you can have the best advisors in the world, and it's your choice to make sure you choose the advisor who's correct for you. But the absolute responsibility comes down to you to make that decision.
Sure does.
An advisor will give you recommendations, but you need to be responsible for making those decisions. Just don't do something blindly because an advisor tells you to do that. Challenge it, get different opinions, get the information you need to make sure that you make the right decision that suits you, because if things go wrong, the person who's responsible is going to be you.
100%.
Good. Just quickly on the valuation side, and going to some of those factors that you talked about right then. If I have two properties side by side on the same street, so you've done every piece of analysis possible using data to work out the suburb, the street, et cetera, two identical houses side by side on the same street. As a valuer, if you walk into those two different properties, you probably already know what it's worth thereabouts.
Yeah.
What's going to be the things that's going to change from whether it's a perception appeal as a valuer, or, you might be able to ratchet up the price of one of those properties $10,000, $20,000, $30,000 more by just doing a couple of things really well.
Yeah. How to differentiate your property from the rest.
Yeah.
And that's a really good point, because what creates value is something that has a little bit of scarcity around it that's a bit different to something else. It's that supply and demand thing again. So some of the easy to do type things. So landscaping is incredibly impactful. So if you've got the time, do some landscaping to a property, and that will be a big differentiator from other properties.
So street appeal type stuff.
Yeah,
right?
exactly. And just making sure there's a connection between the flow of the house and the entertaining spaces. That's big in Australia. We all live outdoors, right? Whether you're in WA or WA is pretty hot, but you want a pergola there, through to the East Coast. So that's one that you can do quite easily, is a little bit of landscaping. That's a weekend of getting some mates in or getting a landscaper in. Things like that make a difference. Things that you can do that aren't majorly structural. The littlest things is light fittings, curtains, and air conditioning. So people often neglect those things. And when I say aircon, you might have it, but it also might be the oldest, ugliest system in the world hanging off every wall. And then you couple that with some dated light fittings and some dated curtains, and that creates a very quick impression of age and a property feeling a bit dated. So making sure those things, and they're quite affordable as well, making sure a couple of those things are updated can make a really big difference to how a property appeals. The good old one, a lick of paint and a bit of carpet makes a big difference as well. But now we're getting into some major works. Once you do paint, carpet, light fittings, landscaping, you've done a whole renovation, right? Yeah. So one of the things that we did, I've sold a couple of blocks of flats over the years where we've strata subdivided them and things like that. And often we wouldn't even redo the bathroom. We'd go in and do the acrylic spray. So very easy, very cheap. It's done in a day, and it really lifts the space for the tiles and baths and things like that. Chuck a new vanity in and you've got yourself what looks like a fairly updated bathroom. And they're all really minor things. So sometimes it's just about lifting the standard a bit. But people often say to me something like, I just put in a new air conditioner. Does that make the property worth, $4,000 more because that's exactly what I spent? And say, well, you neglected everything else. You've still got old bathrooms, old fittings, old carpet. You can't have one item that lifts the property. You've got to create an overall standard. So unless you're doing a major ticket item like kitchen and bathroom, if it's just an air conditioner, if you just put in one new blind or you put in, one plant out the back, that's not going to be what changes it. You've just got to create a standard and try and lift a few things that then give the property better presentation.
So the fundamentals by and large would dictate the value of the property, but it's the 10% which is going to help you plus or minus those few extra dollars in evaluation.
Yeah. And you know what? Even though valuers will look through furniture packages and things like that, when you're putting a property to the market, the presentation is critical. People often have trouble understanding how big a room might be or how functional it might be or how to use it.
Help them out.
Yeah, when it's empty, rooms always look small, and it sometimes looks like you're walking into a big bowling alley. So, put some furnishings into a property. And in Adelaide, for example, it's very common practice. Very few homes are sold without at least a little furniture package in terms of just for the sale period to stage it. So staging can make a big difference just in the marketplace in terms of presentation.
Cool. Running out of time, Anna, but I'm going to keep at this because it's one of our last podcasts of the year, and I'm sure everyone's sitting and going, tell me what I've got to do in 2019. So property markets right across Australia. Where are you guys focusing? Give us some, I put in inverted commas, hotspots, because if someone's hits and misses. If something's a hotspot, and we're talking about it right now, it's probably not a hotspot. So give us the real stuff, the hotspots before they become hotspots.
Yeah. So in a really quick overview, the misses for us next year we're going to avoid is that Tasmania pocket because of all the volatility we discussed. Steering clear of Darwin, it's still retracting. There's still a lot of pain in that market at the moment. Sydney and Melbourne as well, we're going to steer clear of that because they are at a peak or starting to correct. So unless it's an investor that has, cash is king, wants either commercial or wants something that they're going to tuck away for 10 years and knows it's going to push through a lot of pain, there's some bargains to be had for home buyers. There's some bargains to be had for investors, but you've got to push through that pain, and it's going to be a couple of hard years ahead. On our watch list, as I mentioned, is WA, so that's probably more the back half of next year, but where we're actively and proactively buying, definitely in Adelaide, within half hour of the city. There's certainly some amazing opportunity from as little as about 350,000 upwards. There are some pockets to the north I would avoid. Our team call them the zombie apocalypse. I'm not going to name the suburbs because I don't want the hate mail, but if you head up north, you'll get a real quick feel for what I'm talking about. And you can buy there for under 350. That's why we sort of put our benchmark at about 350 plus. So that's definitely a hit for us. Regional hubs, obviously, we want to get a bit more careful about that and be a bit cautious as to whose strategy that suits. Going into ACT, really good opportunity buying at the moment. So ACT has been growing actively. It's at the right stage of the cycle. We cannot get enough rental properties for agents there. They're climbing over themselves to get us to send them more rental properties. The rental market is very hot. It'll go into a pause during and before the election. So we'll see people stopping making long-term property decisions. I'm not saying it's going backwards. I'm not saying it's going to have any problems. It just stops. But there's still some properties that have to sell because people make lifestyle decisions. There's still a few buyers in the market. But if you're an investor, it can be a really good opportunity to pick up a good buy because you're not in the market's not as competitive. Straight after the election, things will go back to normal and it should continue to grow because there's strength there.
Canberra will grow.
Canberra is a really good market, but you need to be playing about 600,000 plus.
It's a few bucks to get in, right?
Yeah. So, Adelaide at 350 to 400 is your buy-in price. 500,000 gets you a really decent property. Canberra at 6 to 7 to get a decent property. But you're getting something really modern with really good tenant profile. So there's certainly our opportunities, the Adelaide and Canberra market, and then a few regional hubs as well.
So Adelaide and Canberra, I'll stick with this because I bet you everyone's going, why? And let's look at the fundamentals why these two markets from your position should continue to be a good investment spot for investors moving forward. So look at Adelaide. So are you saying Adelaide's going to continue to grow? Why is Adelaide going to continue to grow?
Yeah. So the first thing we always want to make sure is it's right timing in the cycle. That's going to overarch everything. I don't care if you put the biggest project in the area, in the world, and the market's declining and it's unaffordable, it won't work until it goes through that pain. So that's where we're in Sydney. So Adelaide's in the growth stage of the cycle, as is Canberra. Adelaide has the hospital project just completed at $2.4 billion. That puts it as the seventh most expensive building in the world. It was number 3 when it began, and the most expensive building in Australia. So that's on the world stage. There is going to be a huge amount of job creation in and the supply chain to the hospital, like, cafes and cleaning companies and all that sort of stuff. You've got your submarines, frigate fleets and corvettes. There's a decade of work out of manufacture and maintenance of them at $39 billion project. You've got Lionsgate have just gone into the old Holden plant. They're batteries and solar innovators. They're creating 1,200 new jobs there. Upgrades to the casino, upgrades to the airport. Like, there's massive job creation coming off the back of a market that is affordable. It's in the top 3 most affordable markets in the country. It's actually more affordable than Hobart, surprisingly, in terms of median price. And it is creating a lot of jobs. So these things are really strong fundamentals. Jump over to Canberra, you've got a really diverse employment market there. So it's not just, a lot of people think it's just if you work in Parliament. Well, it's not. It's the IT companies that have a contract with government for 4 years, and then the accounting firms that have a contract with the IT company for 4 years while they're doing that project. Things like that. Then there's a lot in education. They've got a couple of big projects coming out too as well around the university and around the academies. So there's a big student influx expected there, as well as teaching, as well as diverse jobs. And again, the timing is right because both these markets are lacking in supply. They're not building a whole lot new properties. Having said that, though, I just want to quickly qualify, avoid units. Units don't perform very well in Adelaide. In Canberra, they're oversupplied.
I was going to say, what do you get? Houses, right? We're talking.
Yeah, always freestanding houses. Brisbane is also one that where it's a little bit of a slower burn. There's some major projects coming to Brisbane. When I say Brisbane, I mean within 25 minutes of the CBD. So we're not talking, far northern Brisbane like Coomera, like down in Coomera or down the southern end. Any of those sort of out. Ipswich for us isn't Brisbane. We're talking Brisbane Metro. There's projects coming. We're talking the Hurston Quarter, which is a major, project. It's in the billions in terms of it's a health and lifestyle project. Then you've got the Queen's Wharf, which is a CBD redevelopment. But these aren't set to break ground next year as far as we're aware. So it is a 3 to 5 year plan. So it's going to be a slower burn. But if you want to get in a little bit earlier, there's certainly the opportunity again. The recipe for Brisbane, freestanding house within 25 minutes of the CBD and not in a flood zone. It's almost as simple as baking a cake, that one. But you've got to be able to understand how to look for the properties that are outside of flood zones. You're going to have lending issues, insurance issues, and definitely avoiding the unit market because it is incredibly oversupplied and it's hurtling backwards. Like next year, we're suggesting if we saw 20% negative growth in that unit sector, wouldn't surprise us.
Lots of info there. Anna?
Yes.
Well crystallised. It's good. There's a lot of moving parts there, but I've enjoyed the chat. Thanks for sharing being very open about what you guys are doing as well. And, it's a funny thing with buyer's agents. Some of them hold their cards really close to their chest because they think what they've got is a secret, and that's cool. And some of them do really, really well out of it. And but, there's a big difference between looking at markets and working out what's going to sort of be rising and falling, and then the actual application of that knowledge into securing it. Very, very, very different things.
And most of our clients at the end of the day, they're just really time poor, and they can't think of anything worse than running around the countryside looking at real estate on the weekend and getting call after call from an agent. So, those sort of clients come to us because we are an open book, and the people that want to do it themselves, well, they're not our clients. And if we can help them not get it wrong, great.
That's a good thing, right? And I find most buyer's agents very altruistic in that regards as well. They, even though someone might not want to use a buyer's agent, they just like the idea of making sure people don't make bad investment decisions. That's what we're trying to achieve with this show, right? Try and share the knowledge so you can make smarter investment decisions.
Well, it's hundreds of thousands of dollars in a bad decision often. That's pretty devastating.
The irony of it all, though, is as property investors, normally the best buys you make is when people have made bad buying decisions before you. So anyway, this is the way it works. But Anna, thanks so much for coming in. That's Anna Porter from Suburbanite. Really enjoy the chat. We'll get you back again. If you like what we've chatted about today, or you've got any questions, I can pass through to Anna if you like. Just email editor@smartpropertyinvestment.com.au. So you've got some predictions there for 2019. Tune in a couple of days' time for our last podcast of the year. It's myself and a couple of my colleagues are going to go back over 2018 and look what some people have said and what they're going to be doing in the future. That'll be good fun. But if I don't chat with you before the end of the year, which is literally only a matter of days away, Happy New Year. Use this time over the break to relax a bit and recharge, but also think about what you're going to be doing in 2019. It's good thinking time right now, where you can cut a lot of the noise out of your day-to-day life when you're on holidays and start thinking about wealth creation. It's a good time. Anyway, remember to check out smartpropertyinvestment.com.au. If you're not yet subscribing to our daily newsletter, so you're the first to know what's happening in property and property investment right across Australia, smartpropertyinvestment.com.au/subscribe. And I'll throw this in also to pick up Anna's point. If you want to know what's going on in defence spending in Adelaide, there is literally $200 billion being slated to investing in our defence infrastructure and capability build over the next decade. $35 billion going into our future frigates. It's a $50 billion program going into our future submarines. And we've also got our offshore patrol vessels. First two of them are going to be built out of Adelaide as well. So heaps going on. Check out a thing called defenceconnect.com.au. It's all in there. It'll give you everything you need to know about what's going on in Adelaide and why jobs are going to start getting created. Anyway, we'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.